Good evening, Lois. We are happy to present to you today our traditional versus 130/30 portfolio strategy for ADMS 4501. My name is Melroy, and my colleagues today are Paul.
Hi.
And Yue.
Hi, Professor Kim.
Let's begin. There are a number of topics that we'd like to discuss with you in our presentation today. The first being the oil price and index forecast. We believe that the target price of crude oil 1 year from our starting date, which is October 10th, 2008, is $70 per barrel. We also decided to use the S&P 500 as our market index. This is because of the number of stocks that it includes and its wide variety, meaning it's a better economic indicator of the US and the financial markets. We believe that the target value will be 940 points 1 year from today. Based on this 1 year target of oil price and the S&P 500, we have chosen two buy recommendations: WestJet Airlines Limited of Canada and Costco Shipping of China. Let's start with our traditional portfolio and discuss our first stock. WestJet Airlines is based in Calgary, Alberta. It bills itself as Canada's high-value, low-fare airline and is the second largest in the country. According to its most recent quarterly financial statements, President and CEO Sean Durfee has said that we continue to grow in a purposeful and profitable manner during this time of global credit crisis. We are comfortable with a cash position of over $800 million. The target price for WestJet Airlines stock on the TSX is $13.23. Its current price is $9.36, meaning that the holding period yield is 41.35%. During our analysis, we noticed that there is a high positive correlation between the price of crude oil and the price of jet fuel. Now, according to the same quarterly financial statements, crude oil and jet fuel prices made up over 40% of the third quarter operating costs. Therefore, as the price of jet fuel falls, all expenses will be followed, other things being held. As the price of jet fuel falls, other things being equal, total expenses will fall and the profitability of WestJet Airlines and WJA stock will increase. However, the airline industry isn't impervious to risk. One of the most common risk factors is consumers' perception of the necessity of air travel. We are living in a post-9/11 world where many former airline patrons have decided to take other forms of transportation which are deemed to be safer and more comfortable. There are also political factors. Terrorism is still a real threat in North America, and our terrorist attacks are common during shifts in power. This coming January, the Obama administration will be taking power in the White House. And finally, the economic downturn is probably the most important factor. Revenues are falling, incomes are falling, people's homes are being foreclosed on, and taking air travel has not been deemed necessary. People are cutting back, and 1 year ago from today, more people were traveling, but we believe that this will not be the case in the future. We'll now move on to our second buy recommendation, Costco Shipping.
Our second buy recommendation is Costco Shipping. This stock is listed in Shanghai Stock Exchange in China, and Costco belongs to the industry of shipping, where the fuel oil costs make up 30% of the total costs. Costco Shipping is among the largest shipping companies in China and is one of the leading companies in Asia. The current price of Costco Shipping is 1.12 Canadian dollars, and our estimated 1 year target price is 1.88. And at this price, it will yield a 85% holding period yield. And this estimated price is based on our P/E ratio analysis, and by comparing the actual return with the required rate of return calculated by CAPM, we found that this stock is quite undervalued. And our estimated one-year target price is quite reasonable based on our calculation and analysis, especially considering its 52-week high of 7.47 Canadian dollars. Although this stock is quite promising, there are still some factors that may affect the actual return of COSCO Shipping.